Hello students, this is the third video on income from house property. Already I made two videos on this topic. The first video covering the definition of income from house property as well as determination of annual value with solved problems. The second video is on deduction from income from house property under section 24A and B, already covered in the second video along with the solved problems. I will share the link of both the videos, that is playlist, in the top right corner of the I button as well as in the description box. Please do watch those videos before watching this video to understand better the income from house property concept, which is very significant for the students of BCom, MCom, CS, CS and CMA students of all universities across India. So we'll take up the question. Ninth question till 8th question was covered in the second video. This is the third video, therefore ninth question will take up here. So Mr. Mukherjee constructed a building on 30th June 2017. It had two flats of equal dimension. One flat was let out to a tenant for a residential purpose of monthly rent of 1000 and other flat was let out to a friend for a residential purpose on monthly rent of 1000. So both the flats given on let out basis for monthly rent of 1000 each. Sri Mukherjee paid the following expenses during the year ended 31st March 2024. Municipal taxes 10% on municipal valuation of 20,000. Therefore, municipal valuation 20,000, 10% that refers to 2,000 is the municipal taxes. In the sense, owner has paid, Mukherjee has paid. Fire insurance premium, we don't consider. Rent collection charges, we don't consider as per Income Tax Act 1961. Repairs and alterations, we don't consider. Interior decoration charges, we don't consider. Legal charges for recovery of the rent, any legal charges of the recovery of the rent are collection charges, we don't consider. Interest on loan taken to renovate the second flat, this will be considered. Interest on loan taken to construct, renovate, repair of the house property under section 24. Conservancy tax is kind of a tax levied by municipal authorities in addition to municipal tax. This tax will be considered since it is paid by the owner. Find out the income Mukherjee under the head income from house property for the assessment year 24-25. So if this question is available, we have to calculate the income from house property of Mr. Mukherjee. Very simple, since the data is already available. So we already read the question. So we have to calculate first GAV. How to calculate GAV? GAV is equals to calculation flat 1, flat 2, both the flats were given on let out basis. Therefore, MRV 10,000 each we have taken. Since the question has provided total MRV is 20,000 of the entire building, which consists of two flats. So each flat of equal dimension he has provided. Therefore, we have considered equally 10,000 each as municipal valuation. Then fair rental value is not provided in the question. Whichever is higher, the higher value is 10,000 each. We have taken. Then compared with standard rent has not been provided in the question. Therefore, ERV will be 10,000 only, which should be compared with actual rent received. That is 1,000 into 12 months. That is equals to 12,000 each we have collected per annum from the flat 1, flat 2. So therefore, what is the highest value? The rent received. So whichever is higher is called as GAV. That is 12,000 each is called as gross annual value. Once we determine the gross annual value, we should come to the computation of income from house property. Gross annual value, we have taken 12,000 each for flat 1 and flat 2, less municipal taxes. Municipal taxes 10% on municipal valuation, right? And we have provided that municipal taxes 2,000, that is 20,000 into 10%. That will be divided into two parts, 50%, that is 1,000, 1,000 each. That's the reason why 2,000 into 10% to 50% I kept. So 1,000 each is the municipal taxes. In the same way, conservancy fee is also 300. 300 has to be divided among between two flats, that is 150 each. Once you deduct the municipal taxes and conservancy cess, you will get net annual value, that is 10,850 for each flat. From this, we have to go ahead with the deductions under section 24. 24A is standard deduction at the rate of 30% of the NAV. That is equals to 10,850 into 30%, that is 3,255 each. Then B is interest on loan taken to construct, renovate, repair of the house is allowed. But in this case, renovation of the second house. So how much interest we paid? 4,200. If you deduct both the deduction, that is standard deduction and interest on loan, then you will get the income from house property from flat 1 is 7,595 and flat 2 is 3,000 395. This is the income generated from the house property of the flat 1 and flat 2. If you consolidate these two, the total income comes to 10,990. So in this way you have to calculate income from house property. Very simple and very easy. So we'll take up the next question. Then 10th question. Compute the income from house property of Mr. Anil and Mr. Sunil for the year ending 31st March 2024. From the information given below. Mr. Anil and Mr. Sunil are brothers. They have inherited the house property from their father in equal share. Rent realizable from the property is 27,000 per annum. Municipal taxes to be borne by the landlord, that is owner. Please bear in mind, owner paid the municipal taxes, then only allowed as deduction. If any expenditure of municipal taxes borne by the tenant is not allowed as deduction. So 9,000 per annum municipal taxes. Then property is leased on a leased land and annual lease rent is 3,000. Rent collector is paid. Rent collection charges we don't consider. Property was mortgaged by taking a loan of 50,000 at 10% per annum for the purpose of partnership business. So this is not allowed. Only loan taken to construct, renovate, repair and purchase of the house property is allowed. One flat in this building fetching monthly rent of 500 was vacant for 2 months. Yes, vacancy period is allowed as deduction after calculation of GAV. Once we calculate, before calculation of GAV, we have to deduct this loss due to vacancy. That is 500 into 2 months, that will be 1000. So we'll take up the answer. So when you come to the answer, if you see the computation of income from house property, gross annual value we have taken, rent realizable is 27,000. Since we have not provided MRV, FRV, standard rent, directly rent realizable is 27,000 we have taken, minus loss due to vacancy, that is 500 rupees each month into 2 months, that is 1000 loss due to vacancy we have to deduct. So what is the gross annual value we are getting? 26,000 is the GAV. Minus municipal taxes, 9,000 paid by the owner himself, therefore resultant figure is 17,000. That is annual value of the house property. Which annual value? Net annual value. From this, deductions under section 24, standard deduction at the rate of 30% of NAV, 5,100. Since we have not provided any interest on loan, construct, repair, renovate and purchase of the house property. For mortgaging, for the business purpose or partnership purpose, for domestic purpose is not at all allowed. Only it should be for the purpose of construct, renovate, repair and purchase of the house property. Therefore, income from house property comes to 11,900 rupees. So this is the way we have to calculate income from house property. We'll take up the one more question. So if you take the 11th question, the particulars of residential house completed on 31st May 2021 are given below. Rent is 800 per month, municipal taxes 1800, ground rent we don't consider, insurance we don't consider, interest on amount borrowed for construction of this house, this is allowed as reduction, that is 1000. Collection charges we don't consider. The assessee mortgaged the house for 36,000 to meet the expenses of daughter's marriage and paid an interest of 3,000 on mortgage loan. This will not be considered while calculating interest income from house property. Please, mortgage loan taken for the daughter's marriage, this is purely personal. And during the year, the assessee also claims he had not realized the rent from his tenant to the extent of 2,000. Unrealized rent is allowed as deduction before calculating GAV. So 2,000 is allowed as deduction as per Income Tax Act 1961. Right? And he has provided his claim to the entire satisfaction of the assessing officer that the condition for its admissibility were satisfied. So he has satisfied the assessing officer stating that I kept my best efforts but could not realize the rent of 2,000. We have to compute income from house property. Quite simple. Right? When you come to the answer, computation of income from house property, gross annual value I have taken 7,600. How did I calculate 7,600? 800 rupees per month into 12 months. 9,600 minus 2,000 rupees is the unrealized rent. Then resultant figure comes to 7,600. From this, municipal taxes paid by the owner 1,800. The net annual value is 5,800. From this, we have to deduct deductions under section 24. Under that, we have standard deduction at the rate of 30% of NAV, 1,740. It is a standard deduction. It is allowed as deduction for only let out house property, not for the self-occupied house. So 5,800 into 30%. Interest on loan taken 1,000 is taken for the house property, therefore 1,000 is allowed as deduction. Together 2,740 is the total deduction under section 24. Once you deduct, you will get income from house property 3,060 rupees. Clear? So we'll take up next question. Compute the income from house property from the particulars given below for the assessment year 24-25. Municipal valuation 24,000, actual rent received 30,000 per annum, municipal taxes 2,400, date of completion 31/3/2020. In the sense, it has been completed in the financial year 1920. Which financial year? Last day of 1920. In the sense, we consider 1920 itself it was completed, right? Then date of letting out 1/4/2020. The next financial year is the date of letting out. Fire insurance premium we don't consider, ground rent we don't consider, interest on loan taken for construction of the house from 17-18 to 22-23 at the rate of 15,000 per annum. Financial year 17-18 to 22-23 at the rate of 15,000 per annum. 23-24 current previous year is 10,000. Interest on delayed payment of interest, that we don't consider. So in this question we have concept called as pre-construction period interest. When the building was completed? On 31st March 2020. In the sense 1920 it was completed. Before 1920 any payment made is called as pre-construction period interest. So 17-18 and 18-19, these 2 years called as pre-construction period interest, since the building was stand ready for giving on let out basis in the year 1920. So 17-18 and 18-19, 2 years are pre-construction period. What law says? Pre-construction period is allowed as deduction in 5 equal installments. Clear? So 23-24 is 10,000. So let's start the answer to this question. So computation of GAV, MRV 24,000, FRV is not provided, whichever is higher 24,000. Then we have directly compared with rent received. Since standard rent is not available, therefore rent received comes to 30,000. Once we compare these two, 30,000 seems to be highest value, therefore 30,000 is considered as GAV, gross annual value. So gross annual value we have taken 30,000 less municipal taxes 2,400. Once you deduct 2,400, you will be left with, so once you deduct deductions under section 24, A is standard deduction at the rate of 30%, 8,280, that is 27,600 into 30%, that is 8,280. Then next is interest on loan. So here I told you the pre-construction period interest even available, therefore current year interest comes to 10,000, and pre-construction period interest, that is 2 years, 17-18 and 18-19. 19-20 we don't consider since the building is stand ready for let out. So therefore 15,000, 2 years interest, 30,000, it should be divided in 5 equal installments. So that is 6,000 each. In 5 years it should be deducted. From which year? From 1920, 2021, 21-22, 22-23, 23-24. So the 23-24 would be the last year for deduction. So 6,000 is the pre-construction period interest we have to deduct. Then the collectively total interest comes to 16,000. So total deduction will be 24,280. Once you deduct, you will get income from house property 3,320 rupees. This is the precise way of calculation. So I am taking different types of questions so that you will not be in a peril situation in the examination. You can easily answer the questions. 13th question. Joseph is the owner of a residential house constructed and completed on 31/10/2015 and it has let out from 1/12/2015. Municipal valuation, fair rent, standard rent, actual rent we have given. I am reading very quickly so that we can minimize the time for the video. Then actual rent, municipal taxes including 1,500 paid by the tenant. In the sense, out of 2,500, 1,500 paid by the tenant. In the sense, we have to consider 1,000 as deduction since it is paid by the owner. Only paid by the owner is allowed as deduction. Water and sewerage benefit tax levied by the state government, not paid as a dispute in appeal. If it is not paid, we don't consider. Fire insurance we don't consider. Legal charges for recovery of their rent. Stamp duty for registration we don't consider. Unrealized rent of the last previous year, that is 21-22, is 16,000, of which deduction has been claimed 12,000. So out of 16,000, the assessing officer given deduction for only 12,000. During the year, 14,000 were recovered from the defaulting tenant. So in this current year, we have received the past unrealized rent. So this should be considered separately, we will consider, but calculation of income of house property, it won't affect. It will be taken while calculating total income of the assessee. Compute the income from house property of the previous year. So let's start this answer. First we have to take up computation of GAV, MRV, FRV, whichever is higher is considered is compared with standard rent. Whichever is lower, 18,000 itself, is compared with actual rent received, 16,000 into 12, that is 19,200. Whichever is higher is called as GAV. 19,200 is the gross annual value of the house property. Then computation of income from house property, GAV, we have to take 19,200. From this we have to deduct the municipal taxes paid by the owner. Municipal taxes paid by the owner is 1,000 rupees we have considered, since out of 2,500, 1,500 paid by the tenant. So paid by the owner is only 1,000 we have to deduct. So once we deduct 1,000, the annual value of the house property is, net annual value of the house property is 18,200. First deduction is standard deduction at the rate of 30% of NAV, 5,460. 18,200 into 30%, that is 5,460. Then interest on loan. Interest on loan is also not given in this question. Interest on loan is not given, therefore total deduction under section 24 is 5,460. Once you deduct this, income from house property will be 12,740 rupees is the income from house property. But here we have given last year 2021-22 unrealized rent. So in the year 21-22 we had an unrealized rent of 16,000, but the assessing officer satisfied with only 12,000. So 12,000 unrealized rent claimed in the previous year. Therefore now we have received, so we have to consider that as an income. Total how much we have received? Income 14,000 we have received, of which we have to deduct 4,000. Why we are deducting 4,000? We had 16,000 unrealized rent, but assessing officer admitted only 12,000. So variation is 4,000 was not allowed. That 4,000 we are deducting now. So total income received is 10,000, which should be chargeable to tax. From this we have to deduct standard deduction at the rate of 30%, because it's a let out house property. So once we deduct 30%, the 3,000, then income is 7,000. So income from unrealized rent of the previous year considered in the current year is 7,000. So total income from house property is 19,740 rupees. So the total income from house property is 19,740 we have to consider. So we'll take up the last question. So this is the last question we'll take up. Mr. X is the owner of house, occupies one for his own residence and another he lets out to the tenant at a monthly rent of rupees 500. The municipal valuation of the house property occupied is 2,600 and the others is 5,200. So municipal valuation of the self-occupied is 2,000 and other is 5,200, that is let out. The municipal taxes of the two houses was 600. We have to divide this 600 rupees. The expenses in respect of two houses were annual charges and insurance premium. We don't consider annual charges. We don't consider ground rent. We don't consider repairs. We don't consider interest on loan. We consider. Mr. X had income from other sources 20,000 during the year. Calculate Mr. X income from house property as well as total income. Quite simple question. So first we have to calculate GAV, gross annual value of the let out house property. Self-occupied GAV will be always nil. MRV 52,000, rent received 500 into 12, that is 6,000. Whichever is higher, 6,000 we have to take. Then we will come to the computation of income from house property. First we have to take let out house property, that is flat 1, self-occupied flat 2. So let out house property GAV we have calculated, that is 6,000 less municipal taxes. Municipal taxes, that is total municipal taxes of the building are 600 and the two flats of different dimensions we have, and this municipal taxes should be divided between two flats. In which proportion? Municipal valuation proportion. So joint expenses of the municipal taxes should be divided in municipal valuation ratio. Municipal valuation ratio is 2600 for the self-occupied house and 5200 for the let out house. So if we divide, that is 1:2 ratio we are getting. So municipal taxes for the let out house is 2/3 we have to take. Municipal taxes 600 into 2/3 we have taken, that is 400 rupees. Once you deduct 600 minus municipal taxes 400, 5600. What about the self-occupied house municipal taxes? We don't consider self-occupied house municipal taxes. Deduction under section 24. Standard deduction only on calculated on NAV, that is 5600 into 30%, 1680 is the standard deduction. But whereas self-occupied house, since there is no NAV, no standard deduction. Then interest on loan taken to repair the house. Then total interest we paid 400. That is also will be divided in the MRV ratio, municipal valuation ratio, that is 1:2. So 400 into 2/3 is 267. Interest on loan taken to repair the house 400, that will be divided in MRV ratio, that is 2/3, 267, 1/3 would be 133. In this way we have divided. So income from house property of the let out house is 3653, whereas loss from self-occupied house we are getting 133. Once we get this, we have to calculate GTI. GTI stands for gross total income. Income from house property 3653 minus loss 133. The actual total income from house property is 3520, and income from other sources is 20,000. So total income comes to 23,520 rupees. So this is the way we have to calculate the income from house property. Very quickly I have covered the problems. These problems are very significant for the examination. I wish you all the best. Thanks for watching the video. Do subscribe my channel, Mentor the Trusted Guide, and motivate me to make more qualitative and informative videos. Thank you very much.